So welcome everyone. Thank you for joining us for our user group on energy, enhancing energy finance using a probabilistic approach. I'll be introducing Lachlan in just a second. So I'm just going to take this time while people are jumping on the webinar. To introduce myself, so I'm the moderator. I'm Stacy Penna. I'm with Lumivero, a senior director of marketing partnerships and strategy. So I'll just be in the background helping out with questions and polls and all that fun stuff. So feel free if you have a question to our guest. Lachlan, please put it in the Q&A. That just helps us know it's about the topic. Otherwise, you can chat. Feel free to chat, where you're coming from today and say hi to fellow people joining the user group. And I wanted to introduce our presenter. So Lachlan founded 4D Resources Advisory LLC to help investors, executives, and boards build better energy and mining companies through enhancing the finance function with a probabilistic approach. So hence what we'll be talking about today. He has over 30 years of experience in corporate finance, M&A, capital markets, and investor relations as an investment banker and energy executive. So welcome, Lachlan. We're excited to have you today.
Right, Stacy, thank you.
And before we start the presentation, we just wanted to talk about the two products. I think we're going to be talking mostly about at risk, but we also have decision tools. So I'll be sharing this handout as a PDF in a little while in the chat. So you can go to the links if you want to learn more about the two softwares to help with risk management and decision analytics. And then also we have some more upcoming events. So we have another user group meeting later this week or next week. And then also another one on comparing portfolio allocation. And then Lachlan will be back in a couple of weeks talking about financing using probabilistic approach again. And then we have a webinar on risk insights in integrated energy development also. So feel free to register. I'll put the link in. They're all free events. And then we also have a Lumivero community that has a specific resources and groups and discussions around risk management and our products at risk and DTS. So I'll put the link in the chat later so you can join. It's free. It's a way to keep connecting with people. So with that, I'm going to stop sharing and I'll have Lachlan start sharing his screen. And then we just have two polls for you just so we can learn more about who's attending today. Great.
Good morning and good afternoon to everybody who has joined. Thank you for taking the time to be part of this webinar. So my focus is really helping you understand where we are from an energy finance perspective today and how we can potentially upgrade and enhance that finance function using a probabilistic approach. In many ways, the financial models in the energy industry haven't really evolved in a way that fully reflects its dynamic and stochastic reality. A lot of the inputs that we include in our models are non-linear, which a deterministic or a static approach is less able to model properly. We tend to use rules of thumb and guesstimates for the sensitivity analysis we do around the particular ranges of the input variables, and that can often lead to biases, mistakes, and strategic misrepresentation in the output data. And when it comes to undertaking our sensitivity analysis to understand risk and to also using discount rates as a proxy for risk, as I'll show you, there's a much better way to really understand variability, uncertainty, and risk around the really critical metrics that we look at from a finance model perspective. And in essence, a probabilistic approach will provide an order of magnitude greater insight into the outputs and the data that you're looking for at a significantly lower dollar and time cost. And so if that's the reality, the question then becomes, how do we convince our financial colleagues that a probabilistic approach is really the way forward? And effectively, the best way I have found to do that is to help them understand, how do we make it commercial from day one? how can we include a probabilistic approach using at-risk or the decision tool suite into our financial models to get the output that we need? And more importantly, how do we then incorporate that output into different presentations for the board, for investors, for executives, to help them understand it, appreciate it, not be scared of it, and to use it to make better decisions? And so my intention today is to leave you with the understanding, the appreciation that upgrading the finance function is actually the lowest cost, highest return industry investment available today.
So Lachlan, is it okay if I do the polls now?
That's polls would be perfect.
Great. Okay, so if you do this one on, are you happy with Excel as a primary tool for building financial models? Let's give people a couple seconds to do this. Okay, I'm going to close the poll and then share it. So it looks like we have 81% said yes and 19% said no. And I'm sorry, I added a question I shouldn't have at the bottom. So we had one choice, which probably doesn't make much sense. All right. I'm going to go to another poll and just learn more about how is at risk a key part of the financial modeling process within your organization? Okay, I'm going to end the poll and share it with everyone. So it looks like 38% said yes and 62% said no. So this, so I know Lachlan will be showing some of the software too and how he uses it. So thank you, everyone.
Great, Stacey. Thank you. So as we think about the energy industry, I think it's very insightful to understand how different parts of the industry have evolved over the last 30 years. What we can see from a G&G perspective is in the past, we used 2D seismic, a simple two-dimensional snapshot of the subsurface. Today, we've evolved to a point where we use 4D seismic, where not only do we understand the volumetric nature of the reservoir, but also how fluids change over time. From a drilling and completion perspective, we've moved on from simple vertical wells with simple horizontal completions to complex horizontal wells with complex vertical completions. And so in many ways, the operational side of the business has learned to become a lot more cost-effective. Cycle time has fundamentally been reduced, and that's been very value accretive for the industry. Yet from a finance perspective, we're still using a technology that we've used for the last 30 years, and that's Excel. And so the way we've come to incorporate our input data, the way we've come to run our models and do our sensitivity analysis hasn't really changed over that time. And so as we think about how can the finance function evolve, how can it use Excel, but in a better way to achieve a result that is more cost effective, allows us to get our models completed and the output to the necessary people in a more timely, efficient. How can it become more value accretive from an industry perspective? The really critical thing about financial models and why I wanted to focus on them from a broader perspective was that they really capture everything that we try to include that drives the value of our business. And whether this is from a valuation perspective, M&A, capital raising, leverage analysis, board risk analysis perspective, that's the issue that we deal with, is how do we incorporate the variability of the input data into our models in a way that the output data actually reflects that, rather than coming up and using the deterministic approach we use today, where our models only give us one value per run. And as we think about it, there's so much of the input that goes into it has significant variability and uncertainty. whether we're thinking about it from a management or a strategy perspective, whether we're thinking about it from an operational or an asset perspective, or an accounting or finance perspective, almost all of the inputs that we incorporate into our model is going to have some sort of variability, some sort of uncertainty. And especially from an operational and a finance perspective. When we look at the reserve report, there's variability in that data. As we think about production, as we think about midstream capacity, takeaway capacity, as we think about the exploration parts of the business, there's always a lot of uncertainty there. And so how do we incorporate that into our models in a way that the output accurately captures it? And similar from an accounting and finance perspective, commodity prices, differentials, operating costs, capital costs, they all have significant variability. And so what is the best way to capture that in our financial models? Another really important way to think about why do we need to enhance Excel from what we have is that there are a number of different model types that we use, each of which has a very important output that drives the decision-making process within an organization. So whether we're thinking about the valuation analysis that we do, which is typically based off a budget model, as we calculate NPV, per share value, NAV, whatever metric you're looking at, what is the right discount rate to use for that? What is the right variability in inputs? And then in terms of the output, have we captured the essence of the actual real world sensitivity and variability of those output metrics relative to a deterministic approach? If we think about M&A, the really critical metric we look at there is accretion dilution. And so wouldn't it be helpful to understand what is the probability of a transaction being accretive? Wouldn't that be helpful to boards and executives as they undertake their analysis? And as we get into the back part of this presentation, I'm going to walk you through a number of different transactions, which are actually going to give you insights into how do you use a probabilistic approach to get the output that we need to make better decisions with respect to each of these models and the processes that they drive. It's the same for a capital raising model. As investors try to understand the multiple of invested capital, being able to understand where that falls on the risk-return frontier, being able to quantify the probability of certain returns gives investors a much better sense for, does this investment fit with my risk-return spectrum? From a leverage perspective, leverage is a really critical part of driving E&P energy company value. And so understanding what is the probability of default. We can't do that with our deterministic models, but with a probabilistic model we can. Now we can actually show that the probability of default is X, and we can start to think about, if it's too high, what are the operating, strategic, and financial metrics that we can now utilize to get the probability of default to a level that management is a lot more comfortable with. And in addition, there are a range of other models that we use. One is the board risk analysis model. The board risk and audit function is a really critical part of what they do. And so being able to quantify and rank risks and the inputs that drive variability from a quantitative perspective is really important. And so as I've spoken about these 6 different model types, we all utilize Excel, which is a really great tool from a deterministic perspective. However, as we think about ways to enhance Excel, as we think about ways to fundamentally enhance the quality of the output that we generate through using real-world inputs, a tool like At Risk or the Decision Tool Suite is a very low-cost, effective way to fundamentally increase the order of magnitude and insight that we get from these models. As we develop our models, the sensitivity analysis that we generate is really critical. And that really drives so much of the decision-making process, whether it's capital budgeting, whether it's the correct financing, whether it's the investment decision, whether it's the M&A transactions that get done. But the problem with the sensitivity analysis using a deterministic approach like this is it's extremely limited. And so in this example, we look at two different metrics, growth rate and discount rate. We look at how NAV changes as we change those two input variables. But there are a number of problems with this. The first is that we have no sense of the probabilities associated with net asset value. We have no real sense either of the discount rate and the growth rate of how do they fundamentally contribute to output variability and which one is more important than the other. Which one will have a greater impact over the full range of outcomes relative to what a simple table can tell us. And so in this case, we've used 49 data points. And what we're trying to do there is mimic what the population of outcomes would be for this particular calculation of NAV. It's not quantified around probability. We don't know how well the relationships between all of the variables are integrated. We don't have a sense of what the distribution of outputs actually looks like, i.e., is there a lot of information potentially in the tails of this data? What is the range? And what are the probabilities, especially on the downside results? What are the probabilities of that happening? And what is the impact of that? i.e., does this fully capture black swan type events? And so I think the underlying question is, from an Excel perspective, from a finance perspective, is how reliable are our financial models today just using Excel? Excel is the tool we use, it's the tool we trained in, but is there a better way to use an Excel add-in that will give us that order of magnitude greater insight at a much lower dollar and time cost? Because now we can include the real world variability of all the inputs and their relationships, and that will now be reflected in a population for the output rather than trying to mimic what we think the output could look like using a sensitivity analysis like this. The other issue with using a deterministic approach is, how do we really understand risk? Risk is a critical key part of the decision-making process. And so if we're only thinking about risk from a denominator perspective, i.e. the discount rate, and is that really the best way we have of understanding risk? And what I will show you in the probabilistic output for a number of the different transactions we look at, there are a number of other better ways of understanding risk than simply a tabular form of a sensitivity analysis, or trying to incorporate risk through the discount rate or the denominator that we use. And so I think this is also a really good point to introduce some of the terminology that we're using and will continue to use. Where a certain input metric has a range of potential outcomes and we can't possibly know what they all are, then that input metric has variability. Where that variability starts to impact us, then that gets moved up to really what we describe as uncertainty, which is, we know it's an outcome, it may or may not happen. From a deterministic perspective, we can't assign a probability to it. From a probabilistic perspective, we can. And then, most important, what really is risk? And the way I think about risk is that it's an uncertain event or condition that will have a positive or negative effect on the metric that we're looking at. And so risk is really what we're trying to understand. And the question is, does the discount rate do a good job of understanding risk? Do our current deterministic sensitivity analyses do that? Or is there a much better way using a probabilistic approach to understand risk? And this page is a great insight into how a probabilistic approach helps us understand risk a lot better. And so in this case, we're looking at the per share value for a publicly traded company. Because we've now run our Monte Carlo simulation, we now have 30 or 40,000 different outputs or data points in the per share value histogram. And that's based on the variability of the inputs. And so now on the left-hand graph, now we have a much better sense of what are the potential range of outcomes, and more importantly, what are the frequency of those outcomes. We can also look at the nature of the curve to determine, is the risk, is it more leveraged to the upside or is it more leveraged to the downside? And now that we understand this, we can then make changes to our financial assumptions, whether it's hedging for commodity prices, whether it's potentially focusing on different areas from a geologic perspective to really help get the company's profile to a point that management or executives feel is most value accretive. A probabilistic approach gives us a number of different ways of thinking about risk, each of which is based on that left-hand curve. One is the coefficient of variation. That's simply the standard deviation divided by the mean. And so that is data that instantly falls out of our probabilistic analysis that we can't get from a simple deterministic model. A risk ratio that engineers and geoscientists work with is the P90 to P10 value. The wider that number is, or the bigger that number is, the greater the risk, the greater the variability of the outcome. The smaller that number, the less of the risk. And so we can now use these more scientific or statistically focused tools to understand risk and quantify risk in a way that we never could from a deterministic perspective. We can also look at the nature of the curve. Skewness and kurtosis are two of the metrics that we can look at. And so what this chart seeks to show is that a probabilistic approach provides a far greater insight into overall variability and risk than our deterministic models ever can. And so as we think about the poll that we took at the beginning, 80+% use Excel, 80 plus or more than 80% use Excel. 80% think it's a great tool, and it really is. But the greater the variability in the data, in the input data, the more it's important to make right decisions around the outputs that we get, the less helpful that tool is once you understand the benefits of a probabilistic approach. And so that's what this page really seeks to show, is the left-hand column is very much where we are today. And we use a deterministic approach. We include one value per cell in our models for inputs, which drives the output. Probabilities around those input metrics aren't known or assumed. There's no correlation to reflect the relationship between those variables, and we tend to use guesstimates and rules of thumb for our sensitivity analysis. An improved version of this is to use at risk, where now we've converted our Excel model into a probabilistic model. We're still using Excel. We're using all of the functionality of Excel. All that we're able to do now is include a range of values per cell rather than one value per cell, and incorporate the relationships between each of those inputs. The great thing about at risk is we can understand what those probability distributions or time series functions are to describe the values per cell through using the software. And with the run of your cursor over 40 years of data, 30 years of data, it will tell you, it will calculate what the time series function is or what the probability distribution function is, which you can incorporate directly into your model. It's still a case of garbage in, garbage out, but it gives you the tools to be able to analyze data and incorporate data into our financial models that we can't easily do with Excel. And so an improved version is, rather than getting one of the data points from the left-hand graph, the middle graph shows us now we can actually get a range of values around the output that we're looking at. Most importantly of all, and this is the incredibly valuable part of at risk, is our sensitivity analysis now happens at the push of a button. because our model incorporates all of the variability from the different input variables, it includes all of the potential scenarios. And so we're easily able to understand the sensitivity analysis by clicking on a button rather than having to take days or weeks to do that manually. And so the time-saving aspect to the sensitivity analysis, which is the bottom right-hand graph, is incredibly valuable. In addition, it ranks and highlights quantitatively what the relationship between the input metrics and the output metrics are to give you a sense of what really drives variability for the output that you're looking at. As we discussed in the introduction, a probabilistic approach provides a fundamental enhancement of the data that we get and the decisions that we can make. But the finance group doesn't want to be involved in science projects. The finance group is doing things, it's executing, it's doing budgets. It's often a small group that has a lot of different demands on its time. And so the best way to show the value of a probabilistic approach is to help senior finance professionals understand that it can be made commercial from day one. Once you download at risk, once you incorporate it into your model, it's a relatively easy process to convert your model to a probabilistic model. And then the question becomes, well, how do we use the data to get to better decisions? And this page really gives you talking points for having that conversation. In the pages that follow, I'm going to focus on specific transactions that cover each of these different types. We'll get into the commercial application, or how do you use the data, but I wanted to leave you with a sense of talking points and notes, which effectively define how can we make our financial models better using Excel through the value of an add-in like at risk, i.e., what are the things that the add-in can do that Excel standalone can't do? The very first analysis that we're going to look at is the valuation of a public E&P company. And so in this case, if I had my deterministic model, I would basically do a blowdown of the reserve value in the 10K. I would then use the balance sheet data to understand what the capital structure looks like. I could then incorporate the variability around future commodity prices using a time series analysis. I also understand that approved reserve has a 90% probability that those volumes will be, at least a 90% probability those volumes will be produced. And so now I have a sense for what is the nature of the variability around production. If I'm building a model more from a geologic perspective, now I can incorporate the variability of EUR. I can incorporate the variability of a rig schedule. I can incorporate the variability around takeaway and or processing capacity. And so I can incorporate all of that into the one model. And that's what I've done here. When we ran this model, 50,000 iterations were run. What does that mean? That means that effectively 50,000 sensitivity analyses were run in the traditional deterministic way. And so the model, using Monte Carlo simulation, will pull a data point from one of the inputs. It will then utilize the correlation coefficients or the nature of the other input distributions to determine what other data points should it pull from all the other inputs. It will then run that value, run that analysis, and store that single value. It will do that again and again. And in the space of 60 seconds, I now have a 50,000 iteration output that gives me a much better insight into the range of potential values than I can ever achieve using a deterministic approach to the sensitivity analysis. And so what does this model tell us, most interestingly? The P50 here is 2891. P50 simply means that there's an equal probability that the value is higher or lower than that particular value, depending on how the inputs come together. What's interesting in this case is the market price is $35. what that tells us as a P84 value is that there's a 16% probability based on this model that the value, the per share value, could be higher. And so now we have a quantitative insight as we think about it from an investment perspective. Do I buy, sell, or hold this stock? The other valuable thing that it does, and we'll talk about this in the sensitivity analysis page, a few pages on, is it'll give us a sense, it'll quantify and rank what the primary input metrics are that drive variability. And so I can now understand what are the 3 or 4 primary inputs that drive the variability of this particular company's stock. And so now I have the analysis, now I can put more time into understanding and doing work around those particular metrics and what I think and how I think they could potentially drive the value of the company going forward. The other thing we've done is now we have a P90 to P10 valuation from this particular stock. If I'm comparing a range of different investments, now I have a risk and a return metric. And so I can now plot this on an efficient frontier in a way that it's a lot more difficult to with a deterministic model. And so all of a sudden, just through one model, through using a probabilistic software, I now have far greater insight into what does this particular metric look like, what is the risk associated with this metric, and what are the key inputs that I need to focus on to understand how this could change over time. What's also really interesting here is that within the decision tool suite, there are a number of other analyses that I could do. And so when I run this particular analysis, I have 10 independent and dependent variables. Each now has 50,000 data points. I have 50,000 data points of incremental insight into what drives value for this particular company. And so I can calculate a ratio, maybe based on scale or growth or operating efficiency or capital efficiency or the leverage profile. All of the metrics that we know drive value accretion for resources companies. And now I could do a multiple regression analysis because I have the data to understand which of those metrics actually drives value accretion, which are the metrics that I need to focus on. And so the tool offers multiple ways to really understand and utilize the data that you generate from your Monte Carlo simulation. Another critical analysis that we do is our M&A analysis. And in this case, I wanted to quickly walk through a transaction I did for a midstream company. They were looking to buy an asset to give them geographic diversification in the expectation that would reduce risk. And so we did that. And what we found when we ran our model, in this case, 34,000 iterations to achieve the level of confidence that we were looking for. When it came to accretion dilution, we found the P50 level of accretion was 12.7%. The range was minus 18.5, i.e. dilutive, to 112%. But most importantly, we were able to understand that the level of probability that the transaction was dilutive was only 0.9%, i.e. there was a 99% probability that this transaction would be accretive. And so now we can bring an analysis to the M&A process that we couldn't before. And it's particularly important for accretion dilution, given what role that plays from a fairness opinion perspective. The other really interesting thing about this transaction was the board wanted to understand, does this transaction result in less risk? And so we looked at the value standalone versus pro forma. And what we did there was we calculated the P90 to P10 for the standalone valuation case versus the pro forma valuation case. And what we found there was that the P90 to P10, a critical risk metric, actually declined in the pro forma case. And so what we were able to do was quantitatively show that risk variability of enterprise value actually declined once you combine these two assets relative to what it had been for the standalone asset. And that was something a deterministic analysis couldn't do. And so from an M&A perspective, as you can see, there are multiple ways in which a probabilistic approach will give us data and help us make decisions and answer questions that we can't with a deterministic approach. Another really critical model for energy companies is raising capital. And in this case, a private oil and gas company was looking to raise equity capital. And what it wanted to do was it wanted to help investors understand what is the probability that you will get your money back, and or what are the different probabilities associated with different returns of capital. And so we ran the same analysis here. We included production, commodity prices, OPEX, CAPEX, discount rate, etc. And based on 33,200 iterations for this particular model, we were able to calculate what is the multiple of invested capital. And in this case, it was 7.6 times versus with a range of 2.6 to 19.3. And so here we are. We're able to give investors a simple distribution rather than a deterministic table that now has the probabilities associated with the different returns on the investment that they can expect. And so they can now understand and appreciate and really utilize a lot more the actual investment profile relative to their place on the risk-return spectrum. What this analysis told us was there effectively was a 0%, a very, very small percentage probability that you would not get at least 1 times your investment, i.e. that you would lose money on this particular investment. And similar to the valuation analysis, we're able to show through the sensitivity analysis, investors are able to focus on what are the key inputs that drive variability and do more analysis around those with respect to their ultimate investment decision. The other thing that this does is it introduces an objectivity that a deterministic approach doesn't do. It allows us to have conversations with investors focused on the actual range of outcomes rather than questioning, well, what are the inputs that you used? It allows us to have conversations around, well, how do we leverage the upside? How do we move that P50 value up the curve? What do we need to do to mitigate the downside risk? And so it allows us to have conversations across investors, executives, and boards in a way that we can't really have with a deterministic approach, because we've now quantified what the probabilities are, and we also have a much better sense of how the inputs affect the range of outputs. For the midstream company, we also looked at leverage. And so we wanted to understand there, what is the probability associated with breaching a debt covenant? You know, that seems to be a perennial problem for energy companies, is taking on too much leverage to chase growth. And so having a tool that quantifies the probability associated with default really helps you have better conversations with investors, with boards, and with management. And so that's what we did in this analysis. And what it showed us was that the P50 level of leverage was roughly 1.7 times. And this leverage range is actually very tight. And so you can see that in the nature of the curve. Here, the covenant was 4 times. And so it was really critical that we understood, where does this leverage level fall with respect to breaching the debt covenant? And part of the reason this is so low is the company chose to primarily use equity. Also, there was some hedging in place, but you can see what the effect of that does and how they were able to really minimize the event of default based on this probabilistic output. And what this tells us is that there was an incredibly low probability that they would breach their debt covenants given the capital structure they had chosen. One of the benefits of an output like this is it allows you to have conversations with lenders that you couldn't have before. We can now help them understand what the risk is. We can help them understand what the variability of outcome is, and also the factors that drive that, and how we as a management team have introduced ways, hedging tools to really manage what our capital profile is and how we really seek to mitigate and minimize the risk of default. And so these 4 different outputs, as you can see, they're Excel-based. Everything that you've seen here is completely compatible with Excel. The charts can all be manipulated in Excel. To all extent and purposes, this is all Excel output. It's just that we're using an add-in at risk to incorporate data, a range of data inputs into a single cell, which means we now get that from an output cell perspective. As we also spoke about, the sensitivity analysis is a really critical part of what at risk can give us, what a probabilistic approach can give us. And that to me is actually one of the most important variables, one of the most important valuable attributes of a probabilistic approach is now our sensitivity is all undertaken at the push of a button. This chart, which is roughly 180 data points, 9 input variables by every 5% probability, that's 20. There's 180 data points at a very minimum in this particular graph. More importantly, they quantify risk in a way that we can't with a deterministic approach. The real value of a sensitivity analysis is how much time it saves that we can now put into higher value activities and to enhance the decision process rather than processing to get the data to mimic what at risk actually does. And so as you think about a sensitivity analysis like this, it didn't require guesstimates or rules of thumb for the input ranges. You ran your cursor over the data if you have it. That drives your function. That now drives the actual variability of the input. And so now your input reflects the real world variability rather than guesstimates around, is it commodity price plus or minus 10%, 20%? What's the right range for CapEx, OpEx, etc.? It's particularly helpful when we're dealing with non-linear inputs, where things don't have a simple change over time, where they're a lot more dynamic, depending on where they get pulled from the input function. It also ensures that our sensitivity analysis is now an apples to apples. We're not randomly choosing which input metrics we change while leaving other metrics to not change. And so we've made the sensitivity analysis far more dynamic, far more reflective of the world we live in, rather than an approach that tries to mimic the world that we live in because we don't have the right tools. The other really impressive thing about the sensitivity analysis from an at-risk perspective is that there are a number of functions in the software that allow us to choose what are the inputs that we ultimately want to see in a chart like this. And that's the risk make input function. And so you may have a range of different inputs that you have sensitivity for: commodity prices, production, EUR, OpEx, CapEx. Yet maybe you're only interested in a couple of those actually showing up in terms of the sensitivity analysis. And so you can use the risk make input function to define how this information is presented to the people who will use it, i.e., you're able to give decision makers the insights they need in the data form that they're used to, rather than having to now make it more difficult to them because the data form isn't what they're used to. And so as you can see from the 4 or 5 different transactions that we looked at, a probabilistic approach provides an order of magnitude greater insight. It quantifies the probability of events occurring. It provides a sensitivity analysis that has a much greater level of rigor and responsibility and input discipline to it. And so it really goes a long way to take out the risks associated with randomly deciding what the variability should be across the range of input factors. We've spoken a lot about how do we make this commercial? How do we make a probabilistic approach commercial? We have the software, we have at risk, we have the decision tool suite. We have the people who can help train new users and even existing users into how do we build our models to reflect what the senior decision leaders make. How do we present the output in a way that is going to not make them fearful of the new approach, but actually encourage them to be excited about it because it's answering questions that they have in a much better way. And so as we think about qualitative factors as to why a probabilistic approach to the energy industry could be really value added, that's what this page seeks to do. And so the left-hand box really just goes through everything we've spoken about. The right-hand box really just focuses on, to me, the 5 critical issues that we're dealing with today in the energy industry and how a probabilistic approach can enhance those. We need to do a much better job at making better decisions. The energy industry has, until relatively recently, a relatively poor reputation for returning capital, for delivering on what it said it would deliver. A probabilistic approach will enhance the decision-making process. It will allow us to make capital budgeting decisions, investment decisions, financing decisions in a much better way than we do today. Moreover, we've now done it in a quantitatively rigorous way that reflects the expertise and utilizes the expertise that's already in our companies from an operational perspective. It'll facilitate greater investor interest. Now we can show exactly what the risk-return nature of an investment is, or why we're investing capital in a particular way at a particular time. Where we have a tool that quantifies the outcomes in a way that is far more objective, we will make better decisions which will facilitate greater investor interest. It'll support our ESG focus. From an environmental perspective, it's critical that we better understand what impact the industry has on the communities in which we operate. And so now we can understand better, which marginal projects do we not take on? How do we incorporate the costs of environmental risk and other metrics to make better decisions? From a social perspective, where the industry does not make better decisions, where we are not subject to employees going through the career roller coaster because we now have taken the manageable variability out, we can do a much better job at ensuring that the social aspects of working in the industry are better managed. And from a governance perspective, it's critical that we show we understand risk. It's critical that we can quantify it, that boards can quantify it in a way that all constituent holders in the industry and in society will trust the information that's being provided. And the only way we can do that is with a probabilistic approach. Mitigating climate change risks is also important. And that may be purely from understanding, are the resources going to be there to facilitate the energy transition? What does the transition look like? Is it even possible at the speed with which society would like if the mining resources aren't going to be there? And if they're not, what does that mean about the importance of oil and gas, of renewables, of nuclear and other energy sources to ensuring that we have the reliable, low-cost source of energy supply that's so critical to the society, the economy, and ensuring the society we've created is a sustainable society. And most importantly of all, upgrading the finance function to a probabilistic approach, whether it's at a corporate level, a banking level, a private equity level, it will show that the industry continues to focus on being a leader. The energy industry, from an operational perspective, has shown leadership since Colonel Drake drilled his first well. It has shown it in terms of the Gulf of Mexico, getting out into deep water. It has shown it in terms of making previously, source rock become reservoir rock from an unconventional perspective. But the finance function has lagged operationally what the industry has been able to achieve. But where we upgrade our finance function to a probabilistic approach, where we quantify the data that we're using, where we make better decisions, where we give investors, executives, and boards much better insight to make better decisions, that will then show that we're leading on all parts of the business from a management and strategy, from an operational perspective, and equally importantly, from a financial perspective. And so in conclusion, a probabilistic approach to me really is the low-cost, high-value opportunity the industry is looking for to create a lot of value. It'll help us make better decisions. It'll help us mitigate the risks. It'll help us leverage the upside. It'll help us bring people into the industry who want to be part of it and who can worry less about career volatility. It'll train younger people in, from a finance perspective, ultimately, as AI becomes more of our world, the best way to really undertake the finance function. And most importantly, it'll help the energy industry make better decisions and be able to play more of a leading role in how the global energy base evolves and how we can meet society's increasingly strict environmental, social, and governance requirements. And to me, that is the most important change of all. I think, Stacey, that's it. Happy to open it up to questions. And
Great. Thank you, Lachlan. We have one more poll. So if you want to go to the Q&A, there's 3 questions there, Lachlan, and you can look them over and see which one you want to take first. So, would an experienced third-party consultant be hired to help you enhance a probabilistic approach? I'm just trying to see if the work Lachlan does can help people. Great. Do a couple more seconds and I'll close the poll. Okay, I'll just end the poll, and it looks like we have 36% said yes, 36% maybe, and 27% no. So I think that's pretty fair assessment of what people need. So so do you want me to read off the questions, or do you want to pick one to answer?
I can see the questions, so I'll just go through them if that's okay.
Yep.
So the first question is, how do you describe the net present value if the discount rate is probabilistic? I think that a probabilistic approach isn't about changing terminology. It's not about making things more difficult or creating questions in the minds of users. It's still a net present value approach. It's more recognizing that all of the input variables have variability, that there is uncertainty. And so rather than net present value being one value, it's actually a range of values. And so, yes, the discount rate can be probabilistic. There will be a range of potential outcomes, but you can also correlate that to the output. And so one of the things I think about is, if we end up with cash flows at the very low risk end of the curve, then they shouldn't be discounted at the same rate that the very low probability, high value cash flows are discounted at. And so understanding that there's a range of cash flows and being able to correlate the discount rate to correctly value those cash flows I think that's the real benefit of a probabilistic approach, but ultimately NPV is still a critical variable. The second question, you have cited many advantages of stochastic modeling. The challenge is creating credible distributions for the input variables. What is your advice on how to do that? And you're exactly right. It's still garbage in, garbage out. It's the same rules that apply to deterministic modeling apply to probabilistic modeling. And so there's a number of ways to do that. The first is where you have an input like a commodity price, we can use the historical data to generate a time series. And the software will generate 10 different time series, and they will be ranked by an AIC code. And so what I do is I will look at each of those distributions, those time series functions. I will understand what are the more qualitative factors that we think are going to impact commodity prices, and then I will choose the distribution that best reflects what the expectation is for, if you like, the ranges for the future. Where we don't have data, where it's more difficult, or we only have a limited amount of historical data, then you're right, what is the variability? And so from an engineering perspective, if we have a reserve category, that'll give us an insight into what the right ranges are for that input. For certain other metrics, we won't have any real insight, or the historical data that we have is not a good proxy for the future. And so there, similar to a deterministic perspective, it's looking at trying to find the floor and the ceiling for what's realistic, and then whether you choose a PERT distribution or a triangular distribution to reflect those bookends, that's a way to start to build what the distribution should look like. And it's the same for correlation coefficients. Often we don't have the data for a correlation, but there's still a certain commercial reality for how input variables move relative to each other. And whether we choose 0.4 or 0.5, if we know that they typically move in the same direction, that's not as important as realizing that there is a correlation. It's not 1, but it's also not 0. And using that analysis process to better understand the relationships between the variables to make the best estimates you can for those input variables that you don't have necessarily good data for. The third question, as an explained way of handling uncertainty in capital investment, one of the concerns with the decision analysis, misconception, where decision analysis is considered a method producing an optimal solution to a decision problem, but will not solve a decision problem. So exactly. So the benefits of a probabilistic approach are that it'll give you a range of outcomes, and that's almost only a start. And so as you go through the sensitivity analyses, that then helps you understand which of the metrics drives variability. What are the 3 or 4 critical metrics that I need to understand, that I really need to get right? And so now you know where you need to focus your attention. Where do you need to focus my analysis skills? And so because it's probabilistically based, there's always going to be uncertainty around what is the actual result. One of the great things about at risk is there's actually an optimization function. And so as you think about, do I optimize for capital structure? Do I optimize value for hedging or a certain production profile? You can use the software to actually point you in the direction of what that optimization would look like. And so optimizing it's a function of iterating through the questions that you have to ask yourself to build a deterministic model with respect to inputs and correlations. It's an iterative process with respect to what does the output tell me, what changes could I make to different inputs, and how would that get me to an optimal place, and using the software itself to help direct you towards that optimizing choice of inputs.
A few more questions. There's one in the chat too. To evaluate a new investment project from the KPIS, we have such as the cash flows brought to VPN, the interest rate of the financial loan, the cost of capital, the ROI, and payback. How does the at-risk platform help me?
So that's a really great integrated question. So one, we understand there's going to be variability in the cash flows. So now you can incorporate that into your model. The interest rate of the financial loan, whether that's LIBOR or SOFR based, there's going to be significant variability in that. Now you can incorporate it into your model using a time series to better reflect that variability rather than assuming a potential range. In terms of ROI and payback, you're still using the same Excel functions to calculate that, only now, instead of having one number or a sensitivity table with a range of numbers, now you will have a distribution of those numbers. And so now you will understand the probability of hitting different ROIs and paybacks. And so that will help management or users of the model understand a lot more quickly, does this investment meet those requirements? Does this investment not meet those requirements? And in terms of the investments that do, now you can plot each of those, if you like, on an efficient frontier, because you also have a risk metric. And so now you can plot risk versus return in a way that we could not do before. And so at risk could help you both in terms of building the model, understanding the variability in the critical output metrics that you calculate, and then it also gives you the ability to make different changes in the inputs to understand how do you optimize each of those investments for ROI and or payback. And it'll help you do it in a much quicker time than it would where you have to run all the different sensitivity analyses yourself.
Great, thanks. There's like 3 more questions. Are you okay to stay on?
Sure, absolutely.
Okay. Are lenders and investors becoming more receptive to probabilistic analysis? My sense is that it's mixed. Many still seem to prefer traditional methods.
And I would completely agree with Glenn, which is why I wanted to focus this presentation on how do we make it commercial. I've definitely been surprised by the reticence of some people in the industry to even think about or consider using a probabilistic approach. I completely understand why, but I've learned that the more I can help them make it commercial day one, the more I can explain and then show them from an advisory perspective, how do we convert your model quickly and easily to a probabilistic model? Now we have our outputs. How do we include those in management presentations, board presentations, in a way that doesn't frighten the new users, but actually gets them excited about what this new data tells them? That has been the tool to encourage the thinking and the use of a probabilistic approach. But it's definitely a work in progress. But I would like to think that webinars like this really help people understand that it's a relatively easy path to incorporating a probabilistic approach. And given the order of magnitude of insight versus the cost, it's at least worth considering. Maybe not today, but certainly for the future.
Great. Next question is, would techniques like Swanson's mean assist to representing the probabilistic analysis results for an audience from more accustomed to deterministic analysis?
So I think that's as we think through the steps of how do we help people migrate from a deterministic approach to a probabilistic approach, that's a really great question. And so the short answer is yes. Something like that would really help, but it's not so much the end in itself. It's more a means to an end. It's more a way of slowly bringing potential users along in a way that they are comfortable with the first evolutionary step of going to a probabilistic approach, getting more comfortable that they understand it, that they can utilize it, that the outputs have a lot of value, and then giving them time in their time frame to understand some of the more other purely probabilistic approached metrics such as P90 to P10, coefficient of variation, skewness, kurtosis, things like that. But it is very much an evolutionary process. Finance professionals who come to this will come to it in their own way, in their own time. And any way that we can help get a new user comfortable with applying it, or an existing user comfortable that taking that next step forward because the insight offers is so much more valuable, that's, I think, how we'll get to people using a probabilistic approach and integrating it maybe more quickly than we otherwise would.
Great. And last question is, how can we integrate the AI to the probabilistic analysis? Is that possible?
So that's a great question to finish up. And what's interesting is the decision tool suite already has an AI tool in it. Effectively, the Neuro tools software is almost AI 1.0. Stat tools, which is also part of DTS, that's very much a quantitatively defined regression analysis tool. So as a predictive tool, it can be really helpful, but everything has to be in a number. Whereas neural tools gets us around that. Maybe you're using a postcode. Maybe it's do you have a pool? Do you not have a pool? A lot of qualitative factors can be built into neural tools as a predictive tool, just as it can be built, as things can now be built into financial models. And so I think the AI is important for a number of reasons. One, it makes us all aware that there's a better way to do things from a macro perspective. And now that we know that, it's starting to raise the question in people's minds of how do we enhance the finance function? How do we make it better? And to me, a probabilistic approach using something like at risk is the first step in the evolution of the finance function. AI can be part of that in terms of something like neural tools, or it can be how do we pull the data together? How do we create data for our input distributions, to go back to an earlier question, that we actually can't generate directly today because we don't have sufficient data? And so my sense is that as we look to enhance and upgrade the finance function, it will happen because a number of helpful tools will evolve to help us move that forward. A probabilistic approach is a key part of that, but some of the benefits of AI we can use to answer questions today that we don't have specific answers for with respect to data availability.
Great. Well, thank you, Lachlan. It was a great presentation. People got a lot out of it. So we'll have the recording available soon, which we'll send an email out so people can access it. If you want to reach Lachlan, those are different ways you can get a hold of him. But otherwise, thanks. And there's a short survey at the end if people don't mind filling out. It'll pop up after I stop the webinar. And have a great day.
Thank you, Stacey. And thank you to those who took the time to listen. Goodbye.
Bye, everyone.